For 80 years, the wealthy democracies of Europe did something remarkable. They quietly stopped spending serious money on their own defense. They trusted that large-scale war on their continent was a thing of the past. That assumption died the day tanks rolled across a border in Europe. And now, an entire continent is rearming urgently at enormous scale. For the first time in 3 generations, this is one of the largest spending shifts of our lifetime, and the market is still underestimating how long it lasts. I'm going to walk you through 3 publicly traded defense companies positioned for a rearmament cycle that is measured not in quarters, but in decades. Not a single contractor riding one program that a government could cancel. Not a generic aerospace fund that owns 40 names and a strong view on none of them. Real businesses with factories and order books and government contracts whose revenue is being lifted by the largest sustained increase in military spending the Western world has seen since the Cold War. When a continent decides it has been dangerously unprepared, the correction does not happen in one budget year. It is a structural rebuild that runs for a generation. The trade I want to show you is simple. Do not try to trade the next headline from the next conflict. Own the companies that supply the rebuild itself, because the rebuild has barely started. Let's get into it. First, a level set, because you cannot trade a thesis you do not understand. The story you have heard is defense spending is going up. The story underneath is the end of a very long and very comfortable holiday. After the Cold War ended, the Western democracies collected what was openly called a peace dividend. The great threat appeared to be gone, so they redirected money away from their militaries and toward everything else. For decades, that made political sense. Defense budgets across much of Europe drifted lower as a share of national income. Armies shrank, equipment aged, ammunition stockpiles were allowed to run thin, because who would ever need a deep stockpile of artillery shells again? An entire generation of European leaders governed on the assumption that large-scale industrial state-on-state war in Europe was simply over. Then it was not. A full-scale war returned to the European continent, and it shattered that assumption overnight. And what the war revealed was deeply uncomfortable. It revealed that the comfortable, underfunded militaries of the wealthy democracies were not prepared for a long, intense industrial war. It revealed that ammunition gets consumed at a staggering rate, far faster than the thin peacetime stockpiles could sustain or the slimmed-down factories could replace. The peace dividend, it turned out, had quietly been spent against the risk that came back. Here is the part that should be tattooed on every trader's monitor. The response to that shock is not a one-year budget bump. It is a structural, multi-decade reversal. And there are 3 reasons it has to be long. Reason 1, the hole is enormous. After decades of underinvestment, the gap between what these militaries have and what they now believe they need is vast. You do not refill 30 years of neglect in a single budget. Reason 2, the political commitment has hardened. The members of the Western Military Alliance have committed formally and publicly to spending much more on defense. And the pressure is to push that spending higher still. These are not vague promises. They are stated targets repeated by leader after leader. Reason 3, and this is the one traders most often miss, rebuilding takes time physically. When a government decides to massively increase military spending, the money cannot be absorbed instantly. The factories that build tanks, aircraft, missiles, and ammunition have to expand. Supply chains have to be rebuilt. Skilled workers have to be hired and trained. That industrial expansion takes years, which means the spending does not arrive as a single spike. It arrives as a long, sustained, rising plateau, a flow of orders stretching out across a decade and beyond. A huge hole to fill, a hardened political commitment to fill it, and an industry that can only ramp up slowly. That combination is the definition of a supercycle. So you have a continent that underinvested for 30 years, now committed to a long structural rebuild that the industry can only deliver slowly. When that happens, three things get extremely valuable extremely fast. First, the large prime contractors that build the major platforms, the aircraft, the ships, the armored vehicles. Second, the companies that make the consumables of modern war. Above all, the missiles and the ammunition that get used up and must be continuously replaced. Third, the European defense champions, the home continent companies that the rearming nations have strong political reasons to buy from directly. So I'm going to give you one company per layer. Three names, three different ways to express the same macro bet. Name one, Lockheed Martin, ticker LMT. You probably know this name. It is one of the largest and most established defense contractors in the world. And being the obvious giant is, in this case, a genuine strength. This company is what the industry calls a prime contractor. A prime is the company that holds the master contract with the government and takes overall responsibility for delivering a major complex weapon system, integrating thousands of components and subsystems from a vast web of suppliers into a finished platform. This company builds some of the most significant military platforms in the Western arsenal: advanced combat aircraft, missile defense systems, helicopters, and more. Now, here is what makes a prime contractor a powerful kind of business in a rearmament cycle. When a nation decides to rebuild its military, the centerpiece purchases are the big platforms, and the big platforms are built by the primes. And these are not simple products. A modern combat aircraft is one of the most complex machines ever built, the result of decades of engineering and an enormous industrial base. Only a small number of companies on Earth can build at that level. That scarcity is a deep competitive moat, a barrier so high that new competitors essentially cannot cross it. When the orders surge, they flow to the handful of companies already capable of fulfilling them. Here is what changed. For much of the period after the Cold War, the defense industry was treated by investors as a slow, stable, mature business, steady, dependable, but not a growth story. Defense budgets were flat or drifting, and the companies were valued accordingly as reliable but unexciting. Many investors also avoided the sector for other reasons entirely, and that kept valuations modest. The rearmament shift changes the fundamental growth picture. When the major Western nations commit to sustained, large increases in military spending, the prime contractors are no longer operating in a flat market. They are operating in a growing one, and growing markets deserve to be valued differently than stagnant ones. And there is a second powerful effect specific to the prime contractors. When a country buys a major platform, a fleet of combat aircraft, say, the initial purchase is only the beginning. Those platforms then have to be sustained for decades. They need maintenance, spare parts, upgrades, training, and support across an operational life that can stretch 30 or 40 years. And that long tail of sustainment work flows back year after year to the prime that built the platform. Read what that means. Every new platform sold today is not just one sale. It is the start of a multi-decade stream of high-margin support revenue. The rearmament cycle is, in effect, planting decades of future sustainment income with every platform it delivers. So, what does this mean for the stock? It means a business with a powerfully improved long-term outlook. The demand is structural and political, backed by formal national commitments that are extremely difficult to reverse. The competitive position is protected by one of the deepest moats in any industry. Only a few companies on Earth can build at this level. And every platform sold generates decades of follow-on support revenue. This is the large, stable anchor of the defense trade, and defense primes have generally been disciplined about returning cash to shareholders. The established companies in this sector have a long tradition of paying steady dividends and buying back their own shares. So you are holding a company with a deep moat, a structurally growing market, a long tail of sustainment income, and a record of returning cash to its owners. In a world that has decided it must rearm for a generation, owning one of the few companies that can actually build the centerpiece weapons systems is the natural foundation of the trade. Now, the bear case, three things to watch. One, defense revenue depends on government budgets and political will. A major political shift or pressure to cut spending to address government debt could slow the flow of orders. Two, large complex defense programs are notorious for delays and cost overruns, and a troubled flagship program can weigh on the stock and on profits. Three, Defense stocks have already risen significantly as the rearmament story has become widely understood. So a good deal of optimism is reflected in current prices. So how do you trade it? I am not going to give you a price target. Price targets are how analysts get quoted, not how traders make money. I will give you the framework. This is the large, stable anchor of the defense trade, a deeply moated prime contractor with a structurally growing market and decades of sustainment income behind every sale. Watch two things on every quarterly report. First, the order backlog, the total value of contracts signed but not yet delivered. For a defense prime, a large and growing backlog is years of visible future revenue. Second, the trend in defense budgets among the major Western nations, whether the formal spending commitments are being funded and increased as promised. As long as the backlog is growing and the spending commitments are holding firm, the thesis is intact. If a major political shift were to genuinely reverse the spending commitments, that is the signal the supercycle is in question and your cue to reassess. Name 2, RTX Corporation, ticker RTX. This is, in my view, one of the most direct ways to own the part of the rearmament cycle that the war itself has most violently exposed. And to see why, you have to understand the crucial distinction in defense. The difference between a platform and a consumable. A platform is a durable system, an aircraft, a ship, a tank. You buy it, and it serves for decades. A consumable is the opposite. It is used once and it is gone. And the defining consumables of modern war are munitions, the missiles, the interceptors, the artillery shells, the precision weapons that are physically expended the moment they are fired. This company is one of the largest defense contractors in the world, and it is a major producer of exactly these consumables. It is one of the most important missile makers anywhere, including the air defense interceptors used to shoot down incoming threats. Now, here is why the consumables layer is so powerful in this particular moment. The war on the European continent revealed something the comfortable peacetime militaries had forgotten. A real, intense industrial war consumes munitions at a rate that is almost impossible to overstate. Artillery shells fired by the thousands day after day. Air defense interceptors expended steadily to defend cities and forces. The thin peacetime stockpiles were drawn down at frightening speed, and the slimmed-down factories could not produce replacements anywhere near fast enough. Why does that consumption dynamic matter so much for an investor? Because it creates two distinct, powerful, and lasting sources of demand. The first is replenishment. The Western nations that drew down their stockpiles to defend themselves and to support an allied war now have to refill those stockpiles. And here is the key point. They are not going to refill them back to the old, thin, peacetime level. The war taught them that the old stockpiles were dangerously inadequate. So they are working to rebuild their munitions reserves to a much higher level than before. That is an enormous multi-year wave of orders just to restock, just to get back to a position they now consider safe. The second source of demand is ongoing, and it is even more durable. In a more dangerous world with active conflict and persistent threats, munitions continue to be consumed, and consumed munitions must be continuously replaced. Think about the difference between this and a platform. A nation might buy a fleet of aircraft once in a generation, but munitions are bought, expended, and bought again in the continuous cycle for as long as the threat persists. So the consumables maker is not selling a one-time durable good. It is selling into a structural, recurring, repeating stream of demand. First, the great wave of replenishment, then a sustained higher baseline of ongoing consumption. That is a remarkably powerful position. The numbers that matter for this company are specific. The first is the order backlog, with particular attention to the missiles and defense segment. The value of munitions and missile orders signed but not yet delivered. A large and rapidly growing backlog there is the clearest signal that the replenishment wave is real and that orders are flowing. You want to see that figure climbing. The second thing to watch is production capacity. Whether the company is successfully expanding its factories to increase the rate at which it can actually produce missiles and munitions. This matters enormously, because the constraint in this part of the industry is often not demand. The demand is overwhelming. The constraint is the physical ability to manufacture fast enough. A company that is successfully ramping its production capacity is a company that can convert that overwhelming demand into actual delivered revenue. So a surging munitions backlog tells you the orders are there, and expanding production capacity tells you the company can fulfill them. When both are moving in the right direction, you have a consumables maker position to capture the most acute, most exposed part of the entire rearmament cycle. And it is worth noting, this company also has a large business making components for commercial aviation, which gives it a second engine entirely separate from defense. And here is the kicker. The recurring nature of munitions demand gives this part of the business a quality that investors prize: visibility. Because munitions are consumed and continuously replaced, the demand does not switch off after a single big order is filled. It repeats. That makes the future revenue stream more predictable and more durable than a business dependent on occasional large platform purchases. And the company, like its peers, has generally returned cash to shareholders through dividends and buybacks. Now, the honest catch, and there are two worth naming. First, the production constraint cuts both ways. If the company struggles to expand its factories fast enough, it can fail to capture demand that is genuinely there. And ramping munitions production is genuinely hard. Second, this is a very large company with multiple businesses. So the powerful missile story is one part of a bigger whole, and challenges in another division can affect the overall results. But read it correctly. The core insight stands. The world has rediscovered that it consumes munitions far faster than it stockpiles them, and it is now committed to both refilling those stockpiles and sustaining a higher rate of production. That is a structural, recurring demand stream, and this company is one of the central suppliers of it. The bear case: 1, the production capacity constraint is real. If the company cannot ramp manufacturing fast enough, it may not capture all the available demand. 2, it is a very large, multi-business company. So the missile story is diluted within a bigger whole, and other divisions carry their own risks. 3, like all defense names, it depends on government budgets and political will, which can shift how I think about the trade. This is the consumables sleeve of the defense trade: exposure to the missiles and munitions that get used up and must be continuously replaced. If you believe the world will spend years refilling its stockpiles and then sustaining a higher production baseline, and the war has made that nearly certain, this company is a central supplier. Watch 2 numbers on every earnings call: the order backlog in the missiles and defense business, quarter over quarter, and progress on expanding munitions production capacity. As long as the munitions backlog is climbing and capacity is successfully expanding, the company is converting the replenishment wave into revenue. If demand is clearly there, but the company cannot ramp production, that execution gap is the signal to reassess. Name 3, Rheinmetall. It trades in Frankfurt, and there is a U.S. traded depository form. The ticker investors usually track is RNBI. We have covered 2 large American defense contractors, but now step back because there is a crucial dimension to the rearmament story that an American-only view misses: geography, and specifically the politics of where a rearming nation chooses to spend its defense money. When a European nation dramatically increases its military budget, it faces a choice about who to buy from. And there are powerful reasons, political, economic, and strategic, to direct a large share of that spending toward defense companies based on its own continent. Why? First, jobs and industry. A government spending a vast sum of taxpayer money on defense wants that spending to support factories, engineers, and skilled jobs at home, not entirely abroad. Second, security of supply. The war taught European nations a hard lesson about depending on others. A nation wants the ability to produce its own critical equipment and munitions on its own soil, under its own control, so that its supply cannot be cut off or delayed by a foreign government's decision. Third, there is a deliberate push to strengthen the European defense industry as a strategic goal in its own right. This company is the largest defense contractor based in its home European nation, and one of the most important on the continent. It is in many ways the single most direct corporate embodiment of European rearmament. This is the layer the market consistently underthinks. The home continent advantage? This company makes exactly the kind of equipment the European rearmament demands most. It is a major producer of armored military vehicles, and critically, it is one of the most important producers of ammunition in Europe, including the artillery shells whose desperate shortage the war so brutally exposed. Here is why this company sits in such a strong position. Think back to the single most exposed shortage the war revealed: artillery ammunition. The Western nations discovered that they could not produce artillery shells anywhere near fast enough to match the consumption of a real war. There was a frantic scramble to expand shell production across the continent. This company is right at the center of that scramble. As one of Europe's most important ammunition producers, it has been expanding its capacity to manufacture shells, building new production, racing to increase output. Now, combine that with its armored vehicle business. As European nations rebuild their armies, they need to replace and expand their fleets of armored vehicles. And this company is a leading European supplier of exactly those. So it is positioned across two of the most important categories of the rearmament at once: the consumable ammunition and a major platform armored vehicles, and layered on top of both is the home continent advantage. When European governments decide where to direct their enormous new defense budgets, a major European champion, one that builds critical equipment on the continent, supports European jobs, and offers security of supply, is exceptionally well placed to win that business. The political logic and the commercial logic point in the same direction. The numbers that matter for this company are specific. The first is the order backlog, the value of vehicle and ammunition, orders it has signed but not yet delivered. For a company at the center of European rearmament, a large and rapidly growing backlog is the clearest evidence that the continent's spending commitments are turning into actual signed contracts. You want to see that backlog climbing strongly. The second is, again, production capacity, especially the company's progress in expanding its ammunition manufacturing. Just as with the missile maker, the constraint in ammunition is often the physical ability to produce fast enough, not the demand. A company successfully building new shell production capacity is a company that can convert the European scramble into delivered revenue. So a surging backlog tells you the European orders are arriving. And expanding ammunition capacity tells you the company can fulfill them. When both are climbing, you have the most direct corporate expression of European rearmament that the public market offers. That is the case. And it gives the basket genuine geographic diversification because this company's fortunes are tied to European defense budgets specifically. And here is the kicker. The transformation in this company's outlook has been dramatic. Before the war returned to the continent, it was a solid but unexciting industrial company, partly in defense and partly in automotive components, operating in the flat, low-growth European defense market of the peace dividend era. The rearmament shift has repositioned it entirely into a central supplier for the largest European military buildup in generations. Its order backlog has grown enormously, and it has been investing heavily to expand its capacity to meet the demand. Now, the honest catch, and it is important, this company has risen very sharply as the rearmament story has become widely understood. A great deal of optimism is already reflected in its price, which means it is sensitive to any disappointment. And it is heavily concentrated on the European rearmament team specifically, which is a strength when that team is running, but a concentration risk if European political will were to weaken. Read it correctly. The home continent advantage is real and powerful, but it is also a focused bet. That focus is exactly why it belongs as one leg of a basket alongside the more diversified American primes. It gives you sharp, direct European exposure, balanced by names with a broader base. The bear case: 1, the stock has risen dramatically, so expectations are high and it is vulnerable to disappointment. 2, it is heavily concentrated on the European rearmament team. A weakening of European political will would hit it hard. 3, like all defense companies, it depends on government budgets, and large defense programs can face delays. How to trade it? This is the European champion sleeve of the defense trade, the most direct, most concentrated way to own the continent's rearmament specifically. You watch two things. The order backlog quarter over quarter as the measure of European contracts converting, and the progress on expanding ammunition production capacity. As long as the backlog keeps climbing and capacity keeps expanding, the company is capturing the European build-out. If European defense spending commitments visibly weaken, this concentrated name is where that would show first, and that is your signal to reassess. Now, and this is important, I would not bet the whole thesis on any single one of these names. I would think of them as a basket. Why a basket? Because the three give you the rearmament cycle from three different angles with three genuinely different risk profiles. The prime contractor is the large, diversified, stable anchor. It builds the major platforms. It has a deep moat and decades of sustainment income. And it is the steadiest of the three, the munitions maker's exposure to the consumables. The missiles and ammunition that get used up and continuously replaced, the most acute and recurring demand of all, the European champion is the concentrated direct bet on the continent's build-out, specifically the highest torque of the three. And the one that gives the basket is geographic diversification. Notice the different failure modes. A shift in one nation's politics does not erase the global sustainment income of a diversified prime. A delay on one platform program does not change the structural need to replenish munitions stockpiles. The American names and the European name are exposed to different governments and different budget processes. When you blend the stable anchor, the recurring consumables play, and the concentrated European champion, you get the rearmament thesis across a spectrum of risk and geography instead of betting everything on one company or one continent. When you hold all three, the exposures roughly diversify each other while keeping the central macro bet intact. The Western democracies have ended an 80-year holiday from serious defense spending. The rebuild is structural and will run for a generation. And the companies that build the platform, supply the munitions, and anchor the European industrial base all get paid for that rebuild. One caveat. If you are going to trade the rearmament theme, you have to be honest about its two real risks. The first is politics. Defense spending is decided by governments, and governments change. A major political shift toward cutting budgets, perhaps to address the very government debt problem, that is itself a serious macro story, could slow the flow of orders. The second is that rearmament story is no longer a secret. These stocks have risen substantially as the world has come to understand the supercycle. A good deal of optimism is already reflected in their prices, which means they are vulnerable to disappointment and to sharp pullbacks. But read the long arc correctly. The hole left by 30 years of underinvestment is genuinely vast. The political commitments are formal and have hardened, and the industrial rebuild physically takes a decade or more. I do not think the supercycle reverses soon. The conditions that created it have not gone away, but the prices already reflect a lot. So you buy with discipline and you buy the pullbacks. Position size accordingly. Do not max out on any single name. And keep dry powder for when a hopeful headline about peace or a budget scare sends the whole defense complex down together. Because that is when you accumulate a few catalysts I am watching going forward. One, the defense budgets of the major Western nations, whether the formal spending commitments are being funded and pushed higher. Two, the order backlogs at the major contractors, quarter over quarter. Three, the progress on expanding munitions and ammunition production capacity across the industry. Four, the broad political climate, any major shift in the will to keep spending. If any single one of these key metrics cracks decisively, I will revisit the thesis on this channel. Two more names to keep on a watch list, but I am not buying today. Babi Systems, a major European defense contractor with a broad portfolio. Another strong way to own the continent's rebuild. And Northrop Grumman, a large American prime with deep strength in areas such as military aircraft and space. Another anchor-style defense holding. I will cover both in future episodes when I have more conviction. Let me leave you with the macro frame. For 80 years, the wealthy democracies of Europe lived inside a comfortable and It turned out, fragile assumption, that large-scale, industrial, state-on-state war on their continent belonged to the history books. On the strength of that assumption, they spent the peace dividend, they let their armies shrink, their equipment age, their ammunition stockpiles run thin, and they redirected the money to other priorities. For a generation, it felt like wisdom. And then the war returned to European soil, and the assumption collapsed in an instant. What the war exposed was not just a threat. It was 3 decades of accumulated unpreparedness, laid bare, stockpiles too thin, factories too small, armies too hollow. And the response is now underway formal, political hardened commitments to rearm across an entire continent at a scale not seen since the Cold War. But here is the part the market still underprices. This correction cannot be quick. The hole is too deep. The commitments are too binding, and the industrial base can only expand so fast. It is a structural rebuild measured in decades, a supercycle. That rebuild, a generation of sustained, rising military spending to undo a generation of neglect. That rebuild is the trade. The prime contractor, the munitions maker, and the European champion are not a bet on any single war. They are a way to own the long structural rearming of the democratic world. The holiday is over. The rebuild has only just begun. 3 companies, 3 layers of exposure. 1 macro bet. Lockheed Martin builds the platforms. RTX supplies the missiles. Rheinmetall anchors the European rebuild. If the thesis is right, all 3 compound. If the thesis cracks, you will see it in a handful of specific metrics. And I will tell you here, that is the trade. That is the headline behind the headline. If this kind of breakdown is useful to you, the kind where we do not just react to the headline, we trade behind it. Hit subscribe. I will see you on the next one.